being short something where your loss is unlimited is quite different than being long something that you've already paid for. And it's tempting. You see way more stocks that are dramatically overvalued in your career than you will see stocks that are dramatically undervalued. I mean, it's the nature of securities markets to occasionally promote various things to the sky, so that securities will frequently sell for 5 or 10 times what they're worth, and they will very, very seldom sell for 20% or 10% of what they're worth. So therefore, you see these much greater discrepancies between price and value and on the overvaluation side. So you might think it's easier to make money on short selling. And all I can say is it hasn't been for me. I don't think it's been for Charlie. It is a very, very tough business because of the fact that you face unlimited losses and because of the fact that people that have overvalued stocks, very overvalued stocks, are frequently on some scale between promoter and crook, and that's why they get there. And once they're and they also know how to use that very valuation to bootstrap value into the business, because if you have a stock that's selling at 100 that's worth 10, obviously it's to your interest to go out and issue a whole lot of shares, and if you do that, when you get all through, the value can be 50. In fact, there's a lot of chain letter type stock promotions that are sort of based on the implicit assumption that the management will keep doing that. And if they do it once and build it to 50 by issuing a lot of shares at 100 when it's worth 10, now the value is 50, and people say, well, these guys are so good at that, let's pay 200 for it or 300, and then they can do it again and so on. It's not usually quite that clear in their minds, but that's the basic principle underlying a lot of stock promotions. And if you get caught up in one of those that is successful, you can run out of money before the promoter runs out of ideas. In the end, they almost always work. I mean, I would say that of the things that we have felt like shorting over the years, the batting average is very high in terms of eventual. They would work out very well eventually if you held them through. But it is very painful, and it's in my experience, it's a whole lot easier to make money on the long side. I had one situation, actually an arbitrage situation, when I moved to New York in 1954, so it was about June or July of 1954, that involved a surefire type transaction, an arbitrage transaction. It had to work. But there was a technical wrinkle in it, and I was short something. And I felt like for a short period of time, I felt like Fanova was feeling last fall. I mean, it was very unpleasant. You can't make, in my view, you can't make really big money doing it because you can't expose yourself to the loss that would be there if you did do it on a big scale. And Charlie, how about you?
Well, Ben Franklin said if you want to be miserable, during Easter or something like that, he says borrow a lot of money to be repaid at Lent or something to that effect. And similarly, being short something, which keeps going up because somebody is promoting it in a half-crooked way and you keep losing and they call on you for more margin, it just isn't worth it to have that much irritation in your life. It isn't that hard to make money somewhere else with less irritation.
It would never work on a Berkshire scale anyway. I mean, you could never do it for the kind of money that would be necessary to do it with in order to have a real effect on Berkshire's overall value. So it's not something we think about. It's interesting, though. I mean, I've got a copy of the New York Times from the day of the Northern Pacific corner, and that was a case where two opposing each owned over 50% of the Northern Pacific Company, Northern Pacific Railroad. And when two people each own over 50% of something, it's going to be interesting. And Northern Pacific on that day went from 170 to 1,000 and it was selling for cash because you had to actually have the certificates that day rather than the normal settlement date. And on the front page of the New York Times, which incidentally sold for a penny in those days, it's had a little more inflation than Coca-Cola. Front page of the New York Times, right next to the story about it, it told about a brewer in Newark, New Jersey, who had gotten a margin call that day because of this, and he jumped into a vat of hot beer and died. And that's really never appealed to me as, the ending of a financial career. And who knows, when they had a corner in Piggly Wiggly, they had a corner in Auburn Motors in the 1920s. I mean, there were corners. That was part of the game back when it was played in a kind of a footloose manner. And it did not pay to be short. Actually, during that period, you might find it interesting. In the current issue of the New Yorker, maybe one issue ago, the one that has the interesting story about Ted Turner, there's also a story about Hetty Green. And Hetty Green was one of the original incorporators of Hathaway Manufacturing, half of our Berkshire Hathaway operation, back in the 1880s. And Hetty Green was just piling up money. She was the richest woman in the, probably maybe in the world, certainly in the United States. Maybe some queen was richer abroad. But Hetty Green just made it by the slow, old-fashioned way. I doubt if Hetty was ever short anything. So as a spiritual descendant of Hetty Green, we're going to stay away from shorts at Berkshire.
There's nothing evil per se about, in my view, about selling things short. I would say that it's a very, very tough way to make a living. It's not only often painful financially, it's very painful emotionally, because a stock that you sell short, a stock that you buy at 20 can go down 20 points, and a stock that you sell short at 20 can go up an infinite amount. And you don't think about that until you've gone short and it goes up about 10 or 15 points, and then you don't sleep very well. So it's a very tough way to make a living. There are people on the short side that have done and that do things to try to make stocks go down, some of which are appropriate and some of which are inappropriate. There are people on the long side that have done the same sort of things go on. So I don't see any, I have no axe to grind in the least against short sellers. And in terms of what they call naked shorting, which means that you don't have the stock lined up to be borrowed, and maybe you have a whole bunch of fails to deliver and that sort of thing. I don't have a great problem with that. If anybody wants to do that with Berkshire, they more power to them. Short sellers, the situations in which there have been huge short interests very often have been later revealed to be frauds or semi-frauds. Now, the one my friend runs is not at all, but the batting average, I mean, over the years, I probably had 100 ideas of things that should be shorted, and I would say that almost every one of them have turned out to be correct, and I'll bet if I'd tried to do it and make money out of it, I probably would have lost money. I would have had no fun, and the opportunity cost, as Charlie said, would have been enormous, because if somebody's running something that's semi-fraudulent, they're probably pretty good at it, and they're working full-time at it, and they've succeeded for a while, and they may keep succeeding, and if they succeed and you go in at X and it goes to 5X, all you're hoping after a while is that it goes back to X again or something of the sort. It's a very tough psychological game to play. Few people may be well suited for it. I would never put any money with a short fund, but not because I would think it would be ethically wrong. I just think that they're unlikely to make money. Charlie, do you have any thoughts on short selling or naked short selling?
Well, I think you're absolutely right there, in the sense that that would be one of the most irritating experiences in the world, to figure out something is crooked and foolish and so forth, and then short it at X and have it go to 3X. Now you're watching all these happy crooks splashing around in your money while you're meeting margin calls. Why would you want to go in hailing distance of an experience like that?